Hi, this is Randy Finney with Right Side of the Chart, and today's Thursday, October 19th, 2017. Wanted to do a quick overview on some of the things I'm watching. We'll look at the broad markets, a couple of sectors and commodities that I've been covering lately, and things that I'm watching. Should be a relatively quick update. This We'll start out here with the 60-minute charts of the major indices. This is SPY, the S&P 500 tracking ETF, on the 60-minute chart. And again, I've covered this recently. The bigger picture, again, on the 6th minute, you got to take that out relative to the time frame. We'll jump out to the daily time frames in a minute, but on the 60-minute chart, um, we have this ascending price channel. We have this yellow line here and this yellow uptrend line here. This one needs one more touch to really be validated. So if we come down to this yellow trend line, we also have some horizontal support there around 253.90-ish roughly. Maybe we get a reaction to help validate that trend line. But either way, these lines are parallel. Looks to be it's hard to argue that's been the trend, has been contained by these two lines. So that's our current uptrend in the SPY. And because we've had this unusual price compression, not just price compression, we've had that, but it's also the market's been walking up in an almost artificial ramp where we've had, very well-defined trend lines with very, very small price compression. Again, this is a 60-minute chart, not a daily. The daily chart, it even shows better. But you can see there. So we've had these trends within the larger channel. And once this uptrend line broke, we continued to move up in an uptrend in this price channel, but it wasn't as steep in advance. You can see that. And so today we've had the first technically significant event in a while. Nothing on the daily chart really that stands out yet, but on this 60-minute chart, you can see here we had a breakdown. We gapped down below that price channel, below that fairly well-defined trend line that defines, has contained prices for the last couple weeks, and that's where we're at right now. So the SPY's down a little bit, about 1/4%. Nothing big, nothing to get excited. It might seem like for the first time in a while, because this is the biggest move in a while. But again, it's putting in the bigger picture, it's really not much of a move at all. So what are we looking at? So on the SPY, again, anything is possible. We can continue to keep making divergent highs or even burn through these divergences. But right now, because these steep, very clear negative divergences on the 60-minute chart, more often than not, these play out for correction, if not in so much in price, sometimes in time. You can see we had almost divergence here. We didn't even have it on the 1333, and it was about flatline divergence here on the RSI, and that played out. We did have a little pullback, but it mostly traded sideways for a while. So again, technically speaking, you want to see if you're bearish, you want to see prices remain below this trend line. Maybe we come back in and back test it. And if you're bullish, you want to see the highs taken out. You want to see this breakdown reversed. That would be a bear trap. I'm sure there's a lot of traders, short-term traders, active traders that would short on today's gap down with a stop not too far, either back above, maybe yesterday's close or the recent highs. And doing so, if we get back up above and make new highs from here, this will be a bear trap. Bear traps are pretty powerful. You have all the shorts that jumped in to cover. I don't think there's many shorts left in this market, but we'll see. Anyways, there's the negative divergence that tells me that this probably is a start of something more to come. If we didn't have these divergences, then I wouldn't put too much into this. But that's what I'm seeing right now. So as of now, the near-term outlook for the SPY is bearish. These are support levels to watch. Again, watch this trend line, maybe a reaction somewhere around here if we come back in, and then if we do take out both these intersecting support levels, I don't see the slightest bit of support until down here about 250.26, and from where we're at right now on the SPY, that's a drop of 1.9%. We're going to talk about this in a second, what that would do um, if we got that, and if it happened in relatively short order. I'm talking within the next week or so. If we drop down there, that will have some much more powerful bearish implications, especially when we go out to the more significant daily time frame. So right now, let's just take it for what it's worth, watch it, and I'm just sharing what I'm seeing. So here's QQQ 60-minute chart. Been focusing on these divergent highs. We've been walking our way up here. We had a divergent high, I should say, back here, and we went on. We broke down from that minor uptrend line, and just like SPY, started working our way up within this smaller uptrend here, and that put in another divergent high. So the bigger picture here on the 60-minute chart again is you can see the divergence, negative divergence, started back there. It's been steepening here as the indicators start to roll over. The divergence has increased, and that's a pretty powerful divergent high on the 60-minute chart. We had right here a series of the first divergent high, same story. It was a little more steep, the advance. The advance sort of leveled out a little bit, and the divergence has dropped off, and then boom, we had a pretty good correction, or at least pullback in the Qs. Nothing major, but again, you have to keep in mind, the expected move on these patterns is commensurate to the time frame you're looking at. If you're looking at a 5-minute chart and you note some bullish or bearish divergences, you're looking at relatively small moves, probably only lasting days, if not hours. When you go to the 60-minute charts, those are trends that usually can last at least a few days, if not a few weeks. But again, let's see what this does to the daily charts. Here's the support I'm looking at from now, barring a reversal. Um, I would say that at minimum we're going to go here and test this support zone on QQQ. I have it at 146.09 to 146.44. So we'll call that 146 to 146.50. That's my minimum pullback target from here. Something like this. So let's watch what happens when we get there. The bullish case would see that support level holding on a back test, work off some of the near-term overbought conditions, allow some of those divergences to play out, and then blast off to new highs. However, that's a pretty solid support level. You can see all the reactions back here to the left. And there's some reactions down there from below. There's a gap right there. So this is an important support zone, in my opinion, for QQQ. A break of that level, especially an impulsive move down below, not just a little intra period, a 60-minute candle that just whips down and then closes back above. I'm talking a 60-minute close or an impulsive move down through there. That would do some damage out on the daily time frame. So wrapping up on the 60-minute charts, here's IWM. I've been highlighting for a while now a couple things we've had, but I've been looking at this range right here. We've had this sideways trading range now for the last few weeks, and we had a little whipsaw signal down below, a little whipsaw breakdown, but I did post this either on the front page or, it might have been the trading room. Here's a trend line with several reactions. We've now had 3 reactions. So this is a significant uptrend line at least on the 60-minute chart. And you can see today we gap down below that trend line and we're still below it. So this puts all 3, these major, index tracking ETFs, SPY, QQQ, and IWM have all broken down today. So let's see what happens. But based on everything I see in the charts, I don't see any reason why this breakout will fail. I know this trend has been extremely resilient. And there's still a little more work to do. Trend indicators, they've crossed over, as you can see on IWM, we are now bearish by trend indicators. Most of you have heard me talk about it. I use this 9 EMA on the PPO as well as the 13 and 33 EMA pair. I put it in histogram form, and you can see right now the trend is bearish, and that's the first time that we've had a bearish crossover since, the last time was in late July, all the way back here, end of July, and it never fails to amaze me how well this trend indicator works. That was a sell signal, and it also was confirmed on the 1333, and it told you from this point all the way to right here that the trend was bearish. And the beautiful thing about these trend indicators is that zero line, which is a signal when the 9 EMA and this 1333 histogram crosses above or below those zero lines, they often act as support or resistance when tested from above or below. So you had 2 successful back tests where it looked like you had a little rally, but that rally was stopped cold by these trend indicators coming up back to the zero line. And vice versa, when you cross into bullish territory, then that zero line becomes support. And once support's broken, then the trend has changed. So there it is. And now, again, we're not seeing that yet on SPY and QQQ. And as I said before, um, it's doubtful. There is some temporary minor disconnects between the large caps and small cap stocks, but until the large caps break, you can't expect IWM to fall too much. Chances are it's going to follow the large caps to a larger or lesser degree. So that's the 60-minute charts. Now let's just look at the daily charts real quick and get an idea of the big picture. Okay, we were already on IWM. We'll just stick there. And this is my call it my busy chart. It has all my lines, support levels, potential targets, negative divergence. But you want to look at something very simple. We'll just flip to another board. This is IWM, the old KISS rule here. Keep it simple, stupid. This is just strip out all those other lines, levels. The most salient technical developments that I'm looking at here are these, and I didn't have it drawn out in the past because I flipped boards, but it was on that other chart. You can see the negative divergences: divergence one, correction; divergence two, correction. Now we have this big, large divergence here. So these are the most important things that I'm watching on this chart. It's simply this. The single most important thing is this primary uptrend line. Very well defined. We had a lot of reactions. Reactions here, here, reactions along the way here, a breakdown, an impulsive breakdown. We hit support. Support was very well defined on IWM, the bottom of this trading range here. So we hit support, we bounced up, and now we've back tested that trend line. We overshot it by a hair, but we've now rolled back down below it. Again, we've had divergence. We had, at least on the PPO, we had an extreme, I believe it was the most overbought reading in, if I remember right, 13 years or something on the RSI. So extremely overbought. And then that yellow uptrend line, that really zooms down. That's the same uptrend line as the 60-minute chart that I just showed you. So now we've broken our uptrend, our most recent uptrend, and we tried to regain that primary uptrend line. We did for a little bit, but we've rolled back down below it. So we're below two trend lines, the primary uptrend line and that secondary or minor uptrend line in IWM. So that's that. Big picture on, let's see, SPY. There it is. It's clean. It's a pretty clean board. What I'm watching here is this uptrend line. You can see it come in off the early 2016 lows. So there's a nearly 2-year-old uptrend line, pretty well defined with these reactions. And you can see it forms right now. We're forming a bearish rising wedge pattern with negative divergence. There's your divergences down below. So that's the big picture. SPY has some room to go, but it is in that sweet spot, the sweet spot around 70-80% or so. Well, wrong tool. When you start to approach the apex of a wedge, if it's going to break down, this is where it'll do it. So we have work to do. And I told you I'd talk on something a minute ago. If we had another 2% drop from here, I want to try to visualize what that would do. Believe me, a 2% drop it's not very common on the broad markets, but it's far from unseen. In fact, there's quite a bit. I'm sure we could go back. I haven't looked at this. There's a 1.5%. Actually, no, from the previous day's trading. Yeah, that was 1.5%. Either way, I'm not even talking about it happening in one day. If it takes a couple days to happen, let's just look at this. I'm taking my measurement tool. If you see the pop-up box to the left and showing you what a 2% drop would look like. There it is. It would take us all the way down here to this level. So what would that do? Well, that will have engulfed about the previous 3 weeks of trading. So if we do drop down there, and that was in line with the targets that I had on the 60-minute charts, you can see there's support here as well. There's that trend line. Let's just say we come in and visit that trend line that hasn't been visited in a while. There's that 2% drop. And from my experience, when you have these unnatural market ramps, these extreme low volume and low price compression, these are this is the makings of those mini crashes, the flash crashes, the quick drops, especially when combined with the low volume. So would not surprise me. In fact, I almost expect it to see it happen within the next week or so. Pretty sharp move down, and that would again wipe out 3 months, the last 3 months of gains. That's a pretty bearish technical event. But the big thing is, even if we came down to there, it's not the end of the world. If you're bullish and long, it's this trend line. That's what you want to watch, and you want to watch that on a daily base, a closing basis, a daily close, or a big impulsive intraday breakdown through there. That's going to be a pretty powerful and long-lasting sell signal because of the scope of this pattern. Again, we're on the daily time frame. So wrap up with the QQQ. What board do I have for you on Qs? Board number 6, I think. There it is. Same story. Bearish rising wedge pattern with negative divergences, about as clean as it comes in my book. You can see the negative divergence there. You can see the prices are now, gosh, we're only from where we're at today, right now. If I can grab the middle, that little doji, man, that wedge. If we, let's say we don't even hit it today, we go down tomorrow. That's less than 1% away. There was a little whipsaw signal there, but we got right back up within it, and there's still enough reactions down here to validate that. If you want to play it safe, then what you do is you drag that trend line down here. Maybe you can come in like this, capture those, and then that stretches the trend line down a little bit. I like to give things the benefit of the doubt, especially when the trend's strong. So call it then about 1.85% down to the bottom of that trend line there. All right, let's wrap up here. I did have sectors and commodities to cover, and I'll do those either in a separate video or under separate posts. I want to keep this video relatively short, which we've done here. So those are the levels to watch. Again, 60-minute charts, intraday charts will give you kind of a heads up, a quicker heads up, especially when volatility's been this low. But don't forget about these daily charts, and don't forget about those levels and the significance when you have, you know, a 2-year uptrend line on a daily time frame with multiple tags versus a, you know, a 60-minute trend line that only goes a few weeks. If that trend line gives way, then that's has much longer lasting bearish implications on the daily time frame than those 60-minute time frames do. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.